Hey everyone, welcome back to Cashflow Builders. If you're new here, I'm Sultan, and today we're diving into one of the most powerful skills you can have in business, analyzing financial statements. Whether you're an entrepreneur, an investor, or just looking to make smarter financial decisions, this video is for you. So, grab your favorite notebook and let's get started. First up, let's talk about the three key financial statements you need to know: the income statement, the balance sheet, and the cash flow statement. Each one tells you a different story about a company's financial health. Let's break them down. 1. Income statement, also known as the profit and loss statement. This shows a company's revenues, costs, and expenses over a specific period. It's like a report card for how well the company is doing in generating profit. Look at the top line for revenue. This is the total money earned from sales. Then, check out the expenses section, including cost of goods sold, COGS, and operating expenses. Subtract expenses from revenue, and you get the net income. This is your profit. Income statement, also known as the profit and loss statement. This shows the company's revenues, costs, and expenses over a period of time. It's essentially a report card for a company's profitability. Here's a quick example. Let's say a company has $500,000 in revenue, $300,000 in COGS, and $100,000 in operating expenses. The net income would be $500,000 to $300,000, $100,000, which equals $100,000 in profit. 2. Balance sheet. This snapshot gives you a company's financial position at a specific point in time. It's divided into three sections: assets, liabilities, and equity. Assets are what the company owns, like cash, inventory, and property. Liabilities are what the company owes, such as loans and payables. Equity is the residual value after liabilities are subtracted from assets. A balanced balance sheet means assets equal liabilities plus equity. Balance sheet. This statement provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. It's like taking a financial photograph of the company. Assets include everything the company owns, like cash, inventory, and property. Liabilities are what the company owes, such as loans and payables. Equity represents the owner's claim on the company's assets after all liabilities have been settled. The key here is that assets should always equal liabilities plus equity. Let's look at an example. Suppose a company has $400,000 in assets, $150,000 in liabilities, and therefore $250,000 in equity. This balance sheet is balanced because $400,000, assets, equals $150,000, liabilities, plus $250,000, equity. 3. Cash flow statement. This one shows how cash flows in and out of the business. It's broken down into three areas: operating activities, investing activities, and financing activities. Operating activities show cash generated or used in daily operations. Investing activities reflect cash spent on assets or investments. Financing activities show cash from or used in borrowing and equity financing. Cash flow statement. This statement tracks the flow of cash into and out of the business. It's divided into three sections: operating activities, investing activities, and financing activities. Operating activities show cash generated from daily operations. Investing activities reflect cash used for investments or assets. Financing activities include cash from issuing stock or borrowing money. For example, if a company's operating activities generate $80,000 in cash, it spends $20,000 on new equipment, investing activities, and raises $50,000 through a new loan, financing activities. The net cash flow would be $80,000 to $20,000 plus $50,000, resulting in a positive $110,000 cash flow. Now that you know what each statement represents, let's put it all together with a quick analysis. 1. Analyze profitability. Look at the income statement to see if the company is profitable. A growing net income is a good sign. 2. Check financial health. Use the balance sheet to assess if the company's assets outweigh its liabilities. Strong equity indicates a healthy financial position. 3. Assess cash flow. Ensure the cash flow statement shows positive cash flow from operating activities. This means the company is generating enough cash to sustain and grow its operations. Compare these statements over multiple periods to identify trends. Are revenues increasing? Are expenses under control? Is the company managing its cash flow effectively? Compare trends. Look at these statements over several periods to identify trends. Is revenue growing? Are expenses under control? Is cash flow improving? And that's a wrap on analyzing financial statements. If you found this video helpful, give us thumbs up, and don't forget to subscribe to CashFlow Builders for more tips and tricks on mastering your finances. Comment below with any questions or topics you want us to cover next. Thanks for watching, and remember, knowledge is power, so keep building that cash flow. Catch you in the next video. CashFlow Builders, stay financially savvy.